I know you've been waiting for some videos related to the algorithm I'm developing, and you must be wondering why I've disappeared. Well, it takes a lot of effort. Teach a computer what's in your head. Not only are the nuances of trading, options trading, platform specific nuances are in play here, your own capability of how many hours can you put in is also a restrictive factor. For example, just yesterday, I woke up at 5:45 a.m. and I was working on this till 10 p.m. like non-stop. I didn't take any breaks. So again, one person. So I'm limited by the number of hours I can put in. But I'm glad that I have taken ownership of this and I'm doing everything myself because now I know exactly what line of code does what, and when it fails, I will know that too. Having said that, this is my first video of the series of back tests that I'm going to run on my trading algorithm. And I will walk you through the challenges that I face while doing that. If you look at this sheet, at the bottom, you will see that this is what I'm attempting to do here. Year 2020, 21, 22, 23, 24. These are the 4 years that I'm focusing my back testing on, but I'm also going to include years like black swan years, like 2008 market crash, 2010 flash crash. Because the thing is, these things are rare, but they do happen. That's why they're called black swans. They do happen, and if your algorithm or your, if you're even if you're trading on your own, not using a computer, and you've been making money like crazy, and one moment like this happens, a flash crash, a sudden bear market, and you lose all of that, then all the effort that you put in the last how many years is down the drain. So you need to be aware of these situations, uh, and your whatever your trading method is, you need to first make sure that you have a game plan for when this happens. So that's why I'm going to include all these flash crash scenarios and bear markets in my back tests. But so this is the year 2020 that I'm showing you. This is the back test of 2020, and what I'm doing is for these back tests to keep life very simple. I'm only going to trade SPY for all of these. I tried to include earlier SPY, QQQ, DIA, IWM, XLK, XLY, all that sector ETFs. But it started becoming very difficult for me to gauge what exactly my code is doing. So the easiest way is, let's start with SPY, S&P 500, which is the US stock market. So so the symbol is SPY. It doesn't change right now. Later on, once I get confidence in these results, I will include other symbols and then show you how the algorithm is performing. But this is year 2020, and this is how the spreadsheet is laid out. So you have symbol, you have long strike, short strike, trade type. So if I only take two types of trades: call spreads and put spreads, debit spreads. And so it tells you the trade type, it tells you date opened, day open. And remember, the way I'm coding this algorithm is it only trades on Tuesdays and Fridays. The influence from this came from the current environment we are in since last 2 years, since the Fed started hiking interest rates. So what happens is every week there's some kind of macroeconomic data that comes out. It could be jobs numbers, unemployment numbers, it could be CPI, PPI, PCE, any of those things, GDP. And when those numbers are released, the markets could completely reverse direction. So because of that, it has become really difficult to rely on technical analysis since, I would say, beginning of 2022. So what I've been suggesting to our group is that if you take 4 trades a week, split your allocation between Tuesday and Friday, take 2 trades, form a directional bias on the market. Let's say you're bullish, take 2 trades on Tuesday, then wait for Friday to take the rest of your trades. If the markets did go in your direction, then continue trading in that direction. If markets reversed for some reason, then just take two opposite trades. So if you took two call spreads, take two put spreads to hedge your portfolio. I mean, that's the best we can do in this environment where we keep getting knee-jerk reactions from the markets. So I'm coding my algorithm same way. It only trades 2 days a week, splits the allocation between Tuesday and Friday. So that's that column where it's telling you what trades it took on Friday, then what trades it took on Tuesday, the expiration date, the stock price, SPY stock price at the time of entry, stock price on expiration. So the way I'm doing these back tests is, although profitable trades may close 7 to 10 days before expiration, and I also have a rule that I close all my trades on Wednesday, Wednesday of expiration week, and that is to avoid assignment and exercise scenarios. So I'm not taking that into account, an early close. So in this case, what I've done is, the way I'm measuring my results is, I check the stock price on expiration date, and based on that, I determine if it was a profitable trade or losing trade. So that's that. And then, this is the GTE, for example, days to expiration. For call spreads, I prefer 24 to 35 days expiration. For put spreads, I prefer 11 to 21 days. Put spreads are for shorter duration. So this is DTE. How much? For example, let me pull up a put spread here. So put spread 20 DTE. The first one is call spread 35 DTE. So you can see that. And the final column is winner or loser based on where the stock price was on expiration day relative to the strikes in my spread. And finally, I have some statistics here. What I'm shooting for here is a win rate of 70% or more, because as you know, my trading methodology really shines when my win rate is 70% or above. And in 2020, if you remember, this is the year 2020. If you remember, in our group, I did make 1000% returns that year because my win rate was 70%. I'm shooting for that win rate in my algorithm. Okay, so the first year I picked for you guys is 2020, which is the year of the COVID crash. So needless to say, it's a very interesting year. So I'm showing you the chart of SPY for 2020. And to make things simple, what I've done is I've removed all my indicators and only used EMAs. So 8 EMA is blue, 21 EMA is yellow, and pink EMA is 34 days. And since this is the trend following algorithm, EMAs work really well for that. Now, if you have seen my previous videos, I am also developing multiple algorithms, because not like one algorithm may do really well in 1 year, it may not do that well in the next year. So trend following will do really well if the trend is clearly up or clearly down, but it may not do well in a year where the action is sideways or choppy. So trend following algorithm does really well when there is a trend in place, and 2020 we had a trend after the COVID crash was over. So this is that day. From April, things just went up with some minor corrections on the way. But this crash, I mean, this is a real test of any trader, because it doesn't matter if you're doing algorithmic trading or you're doing manual trading yourself. Can you survive this? That's the main question. Let's just walk through the trades that my algorithm is taking and what's happening in the charts. So the first trade it took is on 1/3. So January 3rd, 2020. Now, if you ignore the entire chart now, if you just look at this portion, from January 1st to all the way to, I would say, February 21st, before the stock market just fell off of a cliff. The trend is up, so the markets are going up. So if you see the trades that my algorithm is taking, 1 3 January 3rd, January 7th, January 10th, 14th, 17th, all the way until 21 February, it's taking call spreads. Now here's the thing, as I'm developing my algorithm, I'm learning a lot about backtesting. So one thing is a big no-no in backtesting is something called look forward bias. And what that means is, as a human, if I'm developing some kind of trading method for myself, if I look at this chart, I can clearly see what's coming my way. I can see that let's see how much the market's dropped. So from February 20th all the way to March 23rd, so a month, markets dropped almost 36%. This is a massive drop, huge drop. So for a human who's looking at this chart, you will be automatically be influenced by this chart. Now the thing is, when you're developing an algorithm, you can't look forward and make decisions based on that. You have to look at the current time horizon and develop your algorithm based on that. Your algorithm should never know what's coming next. So the algorithm in this case is doing great because from 1 3 to 221, so this date, it's taking bullish trades, bull call spreads, because the markets are going up. Makes totally makes sense. Now let's see what happens on February 28th. So this is around this area. So market started dumping. So the COVID crash is beginning to happen. The algorithm is able to figure out that the market direction has changed and it starts taking put spreads. So 228 all the way down to 320. So 228 is here and 320 is somewhere over here. It kept taking put spreads as the markets kept falling. Now, another reminder of a look ahead bias here. Notice that the trades from 317, the put spreads taken on 317 and 320 end up becoming losers. Obviously, we can see that because the markets made a V-shaped recovery after that. But while developing an algorithm, while developing your own trading system, you cannot look in the future. So look at the current time horizon, and at that time it makes sense for the algorithm to take put spreads, and it's doing that. So it's behaving as expected. Now here is the interesting part. So on 320, which is somewhere over here, interestingly enough, the algorithm stops taking put spreads and it goes into waiting mode. And the next trade actually comes on 421. So somewhere over here. So what I've done in the algorithm is it has these two concepts. It took me a while to get this right. So it's able to figure out, I had this big conundrum in my head that when markets go up like this, when you're in a bull market, markets go up, you get pullbacks. Those are buy the dip opportunities. You buy the dip and then markets go back up and then, everybody lives happily ever after. The problem is when markets are going up, and the biggest example of this is the year 2022 when markets actually turned bearish and we were in a bear market for the entire year. So if you are just buying the dips, at what point do you know that you shouldn't buy the dip? The markets are actually going into a bear market cycle. So that's a very tricky situation because if it's in a bull market and you're constantly buying dips, you're making money, and then now the market it changes into a bear market, you will end up losing everything. So the algorithm needs to figure out, and even a human being, if you're doing manual trading, you need a way to figure out if it's a bear market or if it's just a innocent pullback or a buy the dip opportunity. So my algorithm is able to I would say with 95% accuracy, figure out if it's a bear market or it's a pullback. And you will see that in my future videos where I will actually walk you through the year 2022, which is a full-blown bear market, and 2008 as well. So anyway, so in this case, what's happening is this is a massive drop. So all the put spreads that you saw that the algorithm was taking were based on the determination that we are heading into a bear market. But at some point in the algorithm, so it's March 20th, it figured out that the bear market is ending and we are going into a recovery. So it stops. It doesn't engage in any future put spreads. It stops and then it goes into waiting mode. So it goes into waiting mode and then it waits until the EMAs cross over, and which signifies that a new bull run is starting. So the first trade it takes on 421, and you can see from 421 all the way to June, it's taking call spreads, and all of them became profitable from that point on. Now, of course, in June we had a slight pullback here, again reminding you about look ahead bias. So algorithm doesn't know that there is a pullback coming. It's taking its trades based on the current market direction. So market direction is up, it's constantly taking trades, and it kept taking trades until 6-9, which is this point, the peak of the market. So it kept taking bullish trades. Obviously, the ones that are taken recently before the pullback will become losers, and they will need to be managed at 50% loss, which the algorithm does. But so that is what you are seeing here in the list of trades and what's happening in the markets. In my books, this is all good because it can't see the future, so it's making decisions based on what it's seeing at that moment, and this is the right decision in my opinion. And then from 6, so it stopped taking trades on 6-9. The next trade comes 10 days later on 6-19, so somewhere over here. So it made the determination that the pullback is over and it started taking call spreads again, and all of them all the way into August 18th were successful. So let's see where August 18th is. So all the trades taken up to this point are winners. Now, again, there is a correction coming up. If you can see in the charts, the algorithm doesn't know that. There is a correction coming up in September, and any bullish trades taken closer to before the correction starts will become losers, and you will start seeing that now. So if you look at the trades taken from 8:25 all the way to 10:13, so I would say like 1.5 months, all of them became losers. So 8:25 is here. Any call spreads opened until 10:13 became losers because not only did we get a correction in September, October also brought a correction. So this kind of within a month, short 1 month, 2 back-to-back corrections tripped the algorithm. But the thing is that the thing to focus on here is it making the decisions based on the current circumstances? Is it making the right decisions? And it is. So what the markets do is not in your control. The algorithm should follow the rules that you have coded into it, and that's what it's doing. So trading is not about having 100% success rate. Nobody has that. It's all about having more winners and losers. And so this period is perfectly fine. It starts taking, so note this again, October 13th, it stops taking any trades and it starts going into waiting mode because it detects that there's a pullback coming up. And that's really cool that the algorithm detects very accurately a pullback before it starts, and it stops taking any trades. And so the next trade it takes is on 11/6. So let's see where 11/6 is. It's somewhere over here. So it let the market fall, it waited for it to come up, and when the EMAs cross over again, it starts taking bullish trades again. So from 11/6 all the way to the end of the year. It's taking bullish trades. Only one trade opened on 12/4 failed, which is perfectly fine. But yeah, so these are the results of the year 2020. It's looking very promising, very happy about that. And you can see that the total trades it opened in the entire year were 71. Almost 50 trades were winners, 22 were losers. And based on, if you're assuming that you are taking 5 contracts per spread, so every spread is risking $250, your profits were 11,500 and your losses were only 2,750. So this is a great year despite COVID crash, and the win rate is 70% in this year. So I'm shooting for a win rate of 60% or more. If I can get 60%, the algorithm will be successful. I may publish these back tests one more time, because what I'm also working on right now is, the algorithm has a trading range. So if your portfolio is $10,000, it's only allowed to trade between 5 to 30% of that portfolio. So it keeps going back and forth between 5 to 30%. And when it detects a correction, obviously it knows that it's good. All the trades taken just before the correction will become losers. And it goes into waiting mode for the correction to be over before it starts buying call spreads again. Now, what I've also done is, this is something I'm working on, that it increases allocation by 10%. So again, remember the range, it never goes above 30% of your portfolio. So it goes back and forth between 5 to 30%. And let's say the algorithm was trading at 15% of portfolio allocation before a correction hit. What it does is it increases the allocation by 10%. So now it will go to 25%. It has more money, because when the markets come out of that correction, it's going to buy more aggressively. And theoretically, any losses incurred before the correction, or any losses incurred due to the correction, will not only be cancelled out, but you will end up making more money because you are trading more when the correction is over. So I will need to run some back tests if that is helping me, because this particular back test is not taking into account that allocation adjustment. So once I make that, let's see what the win rate becomes. But I just wanted to start this series and show you my first back test. Very excited about this. Now I am facing some challenges with year 2022, which was a bear market. I mean, you would imagine. Let me, without going too much into detail, let me switch to 22. You will be like, this is so easy. Just keep buying bear put spread. That's it. And you make money throughout the year. So there are some issues I'm running into. I'll have to figure out how to deal with them. Main issue I'm running into is, when the algorithm detects a bear market, its detection of a bear market versus the pullback is very accurate. So very happy about that. It figures out that we are in a bear market, and then it starts buying put spreads. But in 2022, what I'm facing is, it'll buy a put spread here, and before the expiration, market will go back up, and that put spread becomes a loser. Then when the EMAs cross over, it will buy call spread, and before the expiration comes around, the markets drop further, and that call spread also becomes a loser. So I think what I'm running into is, I have some thoughts about how to fix this. I think what I'm running into is, the typical DTE, or days to expiration, in a bear market is not the same as a bull market. So this is just 1 year I'm observing. I'll have to run it through several bear markets to see if this was just a anomalous year, and in which case it is fine. I'm not going to mess with the algorithm, because there is this another concept in backtesting called overfitting. So you are looking at only 1 year worth of data, and you're making all these tweaks to your algorithm so that it shows a big win rate, but it only works good for that year. As soon as you go live, your algorithm starts losing money, and you wonder why, because you have overfitted your logic to work only for that year. So I'm fully aware of that. But one thing I've experienced is, at least in 2022, it appears that when the markets, when there is a bear market in place, whether you're taking call spreads or put spreads, the typical 30-day expiration that I'm using for my regular trading doesn't seem to work out. It appears to me that the DTE should be shorter, and I can easily make those changes in my code and run a simulation again. But that's for the future video when I come to 2022. So the next video in this series will be a back test on 2021. So stay tuned, subscribe to the channel, and I will see you soon.